Good afternoon, everybody, and welcome to the third in our series of Utmost How-Wows, talking about tax and trusts. If this is your first one, then welcome. You can use the chat room over on the right-hand side of the screen to ask any questions, and there's a special question bit down the bottom if you want to go there as well. There will be a full replay available of this session as soon as we've finished. You'll be able to get hold of the slides and the CPD certificate as well, and I'll put the link in the chat room at the end of the session. So if you're doing a binge watch, then hello, future you. If you're just doing these as we go, then welcome back. Please join in. These are meant to be interactive. John's brilliant at going through the slides, but if you've got any questions along the way or want us to go over anything again in a bit more detail, then just stick a comment in the chat room and I'll interrupt John and we can go over that thing again. Utmost have put together a really good kind of Netflix style binge page on their website. I'm just going to put a link in the chat room now. So if you want to catch up on any of these events in the future, of course, they're on our website, but the Utmost one actually looks a bit better. So there's the link there. You can bookmark that and go back whenever you want to. Please join in as much as you want to. I'm going to hand over to John now, who's going to give us a quick who he is and what he does, and then we'll kick off.
Thanks, Rich. Afternoon, all. Welcome to new people, and equally welcome to people that have attended the other sessions. I've been in the industry since 1990, working in various, both supporting broker consultant myself, and then I moved into the technical role in 2012. So I've been around a bit, I suppose, in terms of experience and things that I've been through in the industry. If you are wondering who Utmost Wealth are, and you've been hiding somewhere, you'll recall that AXA sold its wealth management business in 2016 and sold that into three different ways. So the Elevate platform went to Standard Life, the standalone products went to Phoenix, and what was the AXA Wealth International business was purchased separately and is now trading as Utmost Wealth. So if you've dealt with AXA Wealth International before, it is that same business with the same people, different branding, and a bit of a different way of looking at the world as well moving forward, totally separate from AXA. So as Rich said, if you've got any questions along the way, then please type away.
Okay, thank you.
And we'll get into the content.
Thanks, John. Well, there's a slide up on the screen, so I'm going to hand over to you now, and any questions we get, I'll jump in and we'll take it from there.
Fantastic. So as you can see, we're going to delve into tax of trust. So some of this may not be entirely new to you, but it's always that subject area where you've got the little guy on your shoulder tapping away, asking, are you really right about what you think about this position? So we're going to have a little journey through different types of trust: bare trusts, IRP trusts, and discretionary trusts. And we'll concentrate particularly on discretionary trusts. So as you know, trusts are one of our main kind of planning tools we have, certainly in the inheritance tax space. But they don't always have to be about inheritance tax. There are many reasons you use a trust. It might be to protect an individual from themselves. It could be around forming a charity. As you know, most pension schemes are trusts. So all I'm saying is, although we're talking about tax today, don't link trusts entirely with tax. There are many reasons we do it. Now, as you know, when a trust is created, we have an individual or individuals called the settlor, and what they're actually doing when they put assets and property into trust, they're passing legal ownership onto some trustees that they have appointed. And there it is. So something I came across a couple of weeks ago was a question around a guy who particularly liked to invest in small cap and have a bit of exposure to that kind of asset class in his portfolio, was putting some money into trust and wanted to continue investing in small cap, which presents a bit of a problem because, as I've said, the trustees actually are the legal owners of the property that goes in there, and they would then decide how that investment is put into the market and what they actually buy in line with the risk profile of the trust. So be under no illusion that when a trust is created, the trustees own it and they are in charge. The settlor in this case could be a trustee. And obviously, once the trustees are sitting there with their assets in the trust and managing it, they're looking after it on behalf of the beneficiaries. And the beneficiaries are pretty important people, really, because they can ask lots of questions, around why did you invest in the market? Why didn't you invest in the market? Where's my income? Where's my capital? Those kind of things. And if I'm honest, if I was ever offered the chance of being a trustee, I probably wouldn't take up the mantle, to be honest. There's plenty of other people who can do that. Professional trust companies can help there. Utmost has one of those as well while I'm talking about that. But I certainly wouldn't relish the opportunity of doing it.
What are the potential implications for being a trustee if you make a cock up?
Yeah, well, if you're found in breach of trust, you could potentially be sued. It could be quite serious, actually, because although you're a trustee and it's a separate kind of life for you, a different hat, it could potentially tumble over into into legal consequences. Absolutely. And it's difficult to say because we have lots of case law where trustees are found in breach and they have to take certain actions. But realistically, it's going to take beneficiaries probably to put their hands up and kick up a stink. There's no real process that's going to say this trustee isn't doing that right. So it's about whistleblowing, actually. And we do have quite a backlog of different case law. I think we're due some new case law. Really, we need to get some fresh material. But it's a serious job. And when I think about when I did the consultant's job, when I had advisors kind of saying, "Oh yeah, I'm putting this in trust," and I've put myself. They want to put it in trust. I'll be a trustee. I've put myself down for that. Knowing what I know now, I really think that's a huge undertaking for an advisor to get involved with. If you think about the time that they could be involved with that trust and the cost of being involved, we have a case going on the Isle of Man at the moment with our trust company where they suspect that the next door neighbour is basically having one over on the it's on and on in terms of property and who owns it now and was she coerced into taking certain actions. So it's basically a blank page in terms of how long it could go on for. So as an advisor, big stuff if you end up with the wrong trust and a rubber problem case ultimately. So I would always think about using professionals if you can. And if you think about family members, lay trustees, if we skip on to the next slide, actually, Rich, that might be best. Even if you're a lay trustee, you have a whole wealth of duties that you have to pay attention to and pay heed to, really. And that's a mixture of common law, case law stuff, as well as statutory duties and powers that are given to you in the law, basically in legislation. So if you are a trustee, the world in which you inhabit is basically made up of the statutory rules and the legislation that sits around it, and what the trust instrument actually says, and then with paying heed to what the set law would like you to do. That's the world in which you live, really, and you have to kind of balance between all those things. So just quickly, standard investment criteria there on the left, a duty that was a duty that was introduced with Trustee Act 2000. That should be meat and drink to an advisor practice, because it's all about selecting the right investment for the right trust, taking account of risk, taking account of diversification, taking account of tax, and that's what we're talking about today, really. So as advisor firms dealing with trustees, you're kind of lifting what you do for individuals and transposing it onto a trust kind of solution. And as I say, if you're a lay trustee, the one above it, skill and care. I think in the seminar before, I've said that trustees have the power to kill and scare, which got a bit of a chuckle. But essentially, that's a measurement, really, of their ability, their knowledge, and how they should be able to deal with a trust case. And the bar isn't particularly, although it is higher for professionals, it's still there for lay trustees. So it's an enormous job. And as you know, just moving down the list there, trustees can take advice if they're feeling they're out of their depth and they can't deal with what they're dealing with, such as investments and financial planning. Then they can take advice and pay for that with the trust proceeds or the trust assets in there. So there are lots of different things to balance. And on the right there, you can see highlighted there the duty to take account of tax considerations, and that's really what we're concentrating on today. It's not just the tax inside the trust, it's the tax on the beneficiary as well, and how that could be juggled. And of course, they're damned if they do, they're damned if they don't. One above, duty not to sit on cash. There was the Midland Bank case versus the Jersey pension trustees, where they sat on cash for 3 months and were taken to court because they missed a rising market. So there's lots and lots of things to think about, and tax is one of them, really. And we're okay at the moment because the stock market's kind of ticking along and generally ticking upwards, more on some days than others. And people tend to think less about tax when the stock market's doing well. When it's not, they think much more about tax, and that's when they would concentrate more on decisions that are being made ultimately.
Richard's put a comment in the chat room about advisors being trustees need to take care of breaching client money rules. And I guess there's also potential conflict of interest. So if an advisor is a trustee and advising the trustees to make an investment and earning a fee off that as well, that could get a little bit sticky, I'd imagine.
Possibly, yeah. I think it probably could. Could.
I was involved in a forum talk last week about the need for any trust investment to have an investment policy statement in place that's put together by the advisor and by the trustees and possibly the settler as well.
Yes.
What's your view on that?
Yeah, I mean, generally the guidance is you've got Trustee Act 2000. Section 11 is the power that allows the trustees to delegate investment decisions to a discretionary manager. Section 15 is the one that says that you should have a policy statement in place. So it really stipulates around discretionary management. Certainly if they're on an advisory basis, then they're kind of doing it, aren't they, via the advisor? But certainly that should definitely be in place in line with Trustee Act 2000. And the policy statement, as you say, outlines the parameters of the trust, the investment, the risk horizon. It could be about the residency of the beneficiaries and what their potential tax status is. Everything is in there. Incidentally, if you come across, in my travels, I go to Scotland as well, and there are some differences. There's a different Trustee Act in place there, and they don't appear to have that requirement in Scotland. If you come across Scottish wordings, I'm not sure if you will or not, but it appears that even though it's not there, people still do that as part of good practice, and it also becomes an FCA requirement as well. So it's well worth doing. And I think in as many ways you can, if you're a trustee, if there are various ways you think you can do a more robust job, then do it. It's all about documentation. And as you know, trustees are required to review their position at least annually. So all this stuff could be part of that process ultimately.
Yeah, the good ones I see
to make sure
tend to be quite simple, but they also have things like a benchmark that the trust is going to measure the returns against. Need for capital, short, medium, long term, and variances.
Yes.
Around that asset allocation. So it's clearly written down at the start what's going to happen, what the plan is, and what's going to happen if things change from the plan. Which means that you're keeping it nice and simple. There's less room for contention along the way.
Yeah, and you think about the families and people that just said, I'll be a trustee for my dad's trust out there. Minefield. So you'll be aware the kind of latest thing out there with respect to the trustees and tax is the Trust Register, which is a new electronic system that came in last year. And one question I've kind of had various times is how did the revenue actually know that trusts exist? Well, you are meant to have registered trusts already. The register is only electronic. It's not new in that sense. So you may have used before Form 41G that put a trust on the radar with revenue, but there's a big difference. The electronic register, the trustees have to register the trust if there's going to be any tax consequence for that trust existing. So that could be stamp duty, that could be periodic charges, that could be income tax, CGT. Whereas the 41G form previously was only required if there was going to be income tax or CGT. So existing trusts that you may have already helped register with 41G still need to be on the system. And you're then into a lot more reporting in terms of named beneficiaries, addresses, dates of birth, assets in the trust, name of the trustees, and so on. It's quite a lot to take in there. But if a new trust is created, you've got until the 5th of October the following tax year to put it on the register, and that's when you get your unique tax reference to help with the self-assessment. But that is the only way you can actually deal with a trust registration now. There is no paper facility. So think about your existing trusts and think about new trusts. Incidentally, as I said, you only need to register the trust if there is a tax consequence. So if you did have a discretionary trust holding a bond, and that's the only asset in there, an investment bond, then outside of chargeable events, certainly for the first 10 years, there is no reason to register that trust because there's no tax event actually occurring. which is entirely different to if you've got a GIA in a discretionary trust, because there will be income coming to pass there, and or CGT. So they would need to be registered. But a bond could mean you don't register the trust until there's something happens, and the first time that happens could be the periodic charge at the 10-year point. And if you want to know more about periodic charges, we did that last week. So if you want to look back, then have a look at that ultimately. And then obviously once the trust is there, the trustees then obviously need to report to their beneficiaries, and they use up form R185 to tell them, which should then inform the beneficiary as to how much they can actually reclaim to reflect their own tax position ultimately.
How does that work with a discretionary trust? Which beneficiaries do you notify?
So you can, if they're named specifically, then they have to go in. If not, it's classes of beneficiary that you're reporting in there, rather than specific individuals on the register. If you stick into Google, just HMRC Trust Register, there's some pretty good sort of guidance on that in terms of who needs to go in and how. So that's well worth looking at if you are. And third parties can register trusts now as well, so that might be something you get involved with for new cases ultimately. But certainly the HMRC guidance is good there. So if we're thinking about trust, having a quick sort of journey across the trust in terms of income tax, a really good place to start is bare trust, because they're relatively simple. Because the thing you have to hold on to is, as long as it wasn't mum or dad who put the money into the trust and settled the trust, you're taxing the beneficiary. So that then means you've got access to lots of allowances. Because what you've got there, if you remember the first session, or you want to look back on the first session, the beneficiary has up to £19,850 of allowances, which is the personal allowance, the starting rate band for savings, the personal savings allowance, the dividend allowance, and of course on top of that $19,000 I just mentioned, you've got the annual exemption as well, another 11,700. So all of that is available. So as long as it's not the parents who put the money in, you see through the trust and you tax the beneficiary or beneficiaries, because you could have more than one beneficiary, which means you've got lots of different allowances there. So although we think quite a lot about junior ISAs and such like for efficiency for children, a bare trust settled by nan or granddad could be a really effective way to use their allowances and create big efficiency inside the trust.
Okay, got a couple of questions for you there, John.
Yeah, sure.
Just going back to the last slide, actually, about issuing a statement to beneficiaries when a tax charge has been levied. If you've got a discretionary trust and the beneficiaries are, let's just say there are no sort of designated beneficiaries, just children or grandchildren of the settlor, let's say, for example, quite a wide range class there. What would you do if let's say you didn't know who they all were? Who do you tell?
That's a good question, actually. I suppose I think really what it comes down to is if you've distributed income to a beneficiary from the trust, then they need to know the tax position. If they haven't, or if you haven't distributed, then the reporting isn't there. I would say I'll confirm that. Maybe I'll come back to you on that, Rich. But I would say it's where you've distributed income to a beneficiary. As I say, that's when they need to know the tax has been paid, so they can take action in respect to their own position. But in terms of Lisa's question about if they don't know who the beneficiaries are, certainly with discretionary trust, even though nobody's named, you will have classes of beneficiary ultimately to think about.
Yeah, I guess.
But certainly in terms of distribution,
I'd take the same view as you. If you have distributed income or created a tax charge, then it's gone out to somebody, and the beneficiaries may or may not have a tax liability going on there. So you've got to let them know that A, that's been created, and B, what they can offset or claim back against it.
Absolutely.
So, as you said, it could be beneficiary tax or trust tax. It could be a bit of both or one or the other.
Well, yeah, exactly. Certainly with a bare trust, Lisa. Certainly with a bare trust, it's the beneficiary's tax position as long as it's not mum or dad who put the money in. Things change a bit as we go through the different taxes potentially, and we'll get there. So it depends. A lot of this stuff depends on who sets up the trust, how it was set up, as we'll also see at the end, and the type of trust. That will then determine whether it's the settler, whether it's the trustees themselves, or it's the beneficiary that's carrying the tax can.
We had a couple of questions come in around bare trusts, which I'll paraphrase, which are: what is a bare trust? Does it have to have a trust deed, or does the designation principle still apply?
Yeah, so be careful with designation. You have to be a bit careful. So where my understanding of that, and correct me if I'm wrong there, is if you've got like a GIA on a platform and they kind of change the name of it and say, right, oh, we're designating that to the child. You have to be quite careful that it's done right, and you have to make sure that it's an irrevocable designation, i.e. you've given it to them and it can't be unwound. If it's revocable, then there's a very, very high chance that the parents, if that's the parents' GIA, haven't actually achieved anything. So I would kind of say use a bare trust anyway. And a bare trust is another term for a bare trust you might come across is an absolute trust. They are the same thing. That's a problem with trusts. There's lots of different terminology that means the same thing. So absolute bare trust, it's a trust you can create where you're putting an asset into trust, generally for a child. Because remember, the downside of a bare trust is that once the child gets to 18, they can say, thanks very much, I'll put this in my name and I'm going to do what I like with it, which some individuals might not want. And that's where they then start to think about a discretionary trust, because they can put the money into the discretionary trust and it's kind of locked away in there until the trustees decide who's going to get what and when. But of course, the difference is if you settle a bare trust, it's potentially exempt transfer, which could be limitless in terms of tax and reporting, as long as you live 7 years. Discretionary trust, you're limited to 325 to 325,000 if you haven't done any other gifting. So it's really between how much you want to put in, what reporting do you want, and really the big decision is how much control do you want and for how long. And most people would tilt more towards discretionary in that way, in that sense.
I think the age at which they can get access is 16 in Scotland.
16 in Scotland.
Yeah, so
absolutely.
Which is even scarier. I know from experience that some investment platforms and providers recognise the designation method and some don't. They will require bare trust. I think either way, documentation is the key here. Whichever route you go down, it's very, very important to document accurately what you've done. So if ever it's questioned in the future, keep it with your will on that kind of stuff. Documentation is the key.
Yeah, that's all I'd say on designation. There is history of challenge around this. If you want to be absolutely certain that you're achieving what you want, use a bare trust. Simple. So just a quick example of the bare trust situation. So we've got Grandad who wants to help out with the school fees. And the school fees are £4,000 a term, so £12,000 a year. So Grandad puts £100,000 into bare trust for the benefit of his grandson. And just for the case of the example, we're gonna invest in an offshore bond. And I'll explain why on the next part. So there's a table. So sticking with line 1, 100,000 went in. It's grown to 105,000 over a year, and at the end of the year, £12,000 of school fees is withdrawn. The three terms worth. So for those that are quick at maths, you would have been thinking, well, 100,000 went in, £5,000 would be our tax deferred withdrawal, and we've had 12,000 out. So there is a £7,000 chargeable event, but we're seeing through the trust because Grandad put the money in. We're taxing the grandson, and remember, an offshore bond, the gains from that are taxed as savings income. So the grandson actually has £17,850 of allowances to spend against that gain. So although it's a chargeable event of £7,000, there is no tax to pay. It's just soaked up with his allowances, and he's not even getting through his personal allowance for that £7,000. So on we go through the 10-year school fees period, and the capital has been run down to about £12,000, and you're kind of intuitively thinking, well, we haven't paid any tax on the way through. Surely there's going to be something coming back to bite us when we surrender at the end. And as you know, the bond formula, 11.9 is what we got left. £120,000 is the total of all the withdrawals we've ever taken. So we add those up and we knock off original investments, and we also knock off anything that's been exposed to tax already, the chargeable events, the 70,000. So when you crunch the numbers through, you actually end up with a negative gain, £38,000. So there is no tax to pay at the end either. So that can be a really effective way of doing it. Now, so non-parental settlements with bare trusts, offshore bonds, really good fit because they're gross wrappers and we can use allowances for the grandchild on the way out. Collectives as well, GIA, undeniably powerful in there as well because you've got all the allowances I've described, plus the dividend allowance, plus the annual exemption. So a mixture of those two, depending on what you want to achieve, could be really good. Onshore bond, tax inappropriate in a bare trust, I'd say, because you can't claim any tax back. If you're dealing with mum and dad who want to put money in, then you could use an offshore bond in there, as long as you aren't going beyond your allowances beyond the 5%. And don't forget, the parental settlement rules only apply until the child is 18 or 16, I suppose, in Scotland. Once they get to that point, at 18 or age of majority, you can then make assignments to them and use their allowances anyway. So you could do it that way. If you did go collectives, then you could go for low income producing portfolios to limit the damage that goes back to mum and dad. And as if you're within the £100 income, which sounds unlikely, there won't be any tax going back on them. And the thing to remember with all of this, even if it's a parental settlement, it's only about income tax. The capital gain always comes back to the beneficiary on a bare trust. It's a different ways to play it. And in all of this, I'd kind of say, if we're looking at those allowances, the 17,850 of allowances with the personal allowance and the savings allowances, collectives can use those, but you're relying on the yield you're receiving from the funds you're invested in to fill up the silos. With a bond, you could actually, an offshore bond, you could actually take a 5% withdrawal plus £17,850 if there's no income for the child, and you still won't pay any tax. So you can really control the agenda and fill up the buckets if you want to do that. So moving swiftly on to interest in possession trusts and IPD trust. So if you're thinking about what an IPD trust is at the top there, it stands for immediate post-death interest. In John Haley speak, it's an IIP trust that's set up when you die via your will. That's all it is, really. That's the technical name for it. Now, there's my visualization, if you like, of an IIP trust. So there's a box with a tunnel through it. So the thing to remember about IIP trusts is that they are basic rate tax paying animals. So within the trust, although we think of maybe 45% for trustee tax, they are basic rate. So we're only paying 7.5% on divvies, 20% on other income. And as you know, if you visualize the structure of an IIP trust, you have your life tenant who's entitled to income. So there's our lady there who's the high rate taxpayer. She gets income and trust enjoyment of the trust property, and the remainder men get the capital when she dies or her life tenancy finishes. And essentially what happens is that dividend goes through the tunnel from the trustee investment, shoots through the tunnel straight to the higher rate tax paying life tenant of the IIP trust. Now, if it goes through the trust, the trustees have got a liability to basic rate tax. So they pay 7.5% on that dividend. They don't get any dividend allowances as well, remember. When it gets into the hands of the life tenant, they then have to pay tax based upon their own position. So she's a higher rate taxpayer. She hasn't got a dividend allowance, and the trustees have already paid £75. So there's a further £250 to pay to balance the books up to £325. Now, things have changed a bit for trustees. We talked about self-assessment. We've moved a bit lately, haven't we? Because we now receive gross dividends and we now receive gross interest. We can have that from the bank as well. And previously, trustees would have been receiving net income taxed at source, and they probably didn't have to do any real self-assessment. But now, even if you're an IIP trust, with the advent of things being paid gross, they will start having to self-assess where they perhaps haven't had to do that before. So it will become a little bit more onerous being an IIP trustee. But there is a way forward potentially to think about. And that's where you can, I believe some platforms allow this. From memory, Elevate allowed it in the AXA days. You can actually mandate payment of the income directly to the life tenant. So that means the trustees don't have to worry about self-assessment. It goes straight to the beneficiary. And she, of course, then would have to pay £325 of tax. All I'd say is if you're going to do this and you've got IIP, it's fine. For reasons that will become clear, don't go anywhere near this facility on a discretion. And as I say, I believe Elevate allowed you to do that with a discretionary trust, which you wouldn't want to do. In terms of investments for IIP trusts, really, you've got to deal with income producing investments. Certainly we are dealing with a trust of this type because the life tenant needs income. And that raises the question of investment bonds. They don't really fit inside an IIP trust for that purpose. And case law, going back to 1933, shows that if the trustees pay out a stream of capital to support income for the life tenant, revenue there's a big chance they'll say that's assuming the nature of income, so we're going to tax it as income. So you can't use particularly onshore bonds for producing income for the life tenant. You may have the power to advance capital to the life tenant, which is a slightly different thing, but you still may then want to make payments that are irregular and of different amounts to make sure it doesn't look like a stream coming through. As you can see there, the list of income producing stuff. So discretionary trust, as I say, I want to concentrate on this a bit because it's the most involved really. So it's called the RAT, the rate applicable to trust, which is quite fitting. So within a discretionary trust, the first £1,000 of your income is taxed at basic rate. So the way this works is a lot like the interest in possession trust we just looked at. So basic rate inside that band, and that standard rate band was originally introduced to lift. They estimated a third of trusts out of self-assessment because income coming in there, if that was all they had and they didn't go beyond the £1,000, if that was taxed at source, then the trustees didn't have to self-assess. But again, we're now dealing with gross divvies, gross interest. That's not serving its purpose anymore, that box. And I would say more and more trustees will have to self-assess. Once their income level goes above that £1,000, they're into the whole world of paying that is additional rate tax, as you know. So 45% tax on any income they receive, 38% on divvies. And remember, again, no dividend allowance as an individual would get. And, you know, if you think about an individual, they can get to £150,000 of income before they get to 45% tax. Discretionary trustees can get to 1,000. That's the real difference. That £1,000 band as well, if the settler has been particularly busy and has been creating a number of different trusts on different days, then that standard rate band will be divided up to a number of 5 times. So it could go down to £200. So a big thing on fact finding to establish how many trusts are in existence to make sure how big that band actually is. Now, one other burden, if you like, that discretionary trustees and accumulation and maintenance trusts have to bear is the tax pool that you may have heard about. And what this is, in its simplest form, is kind of a record, a ledger of the tax that's been paid by the trust, either tax that's paid at source or tax that the trustees have physically paid. So, you know, as I say, it's a register of the trust they've paid. However, it's got a more important purpose, and this is to determine how much tax credit an individual gets, i.e. a beneficiary. And if there's not enough money in the tax pool to support the income they've paid out, they've got to make up, they will get a tax charge that the trust has to bear from somewhere else. So the tax pool is quite a big thing. In reality, it's a rolling thing as well. So they may have some tax pool left over from previous years. The numbers we're about to look at assume they've started from a 0 point, if you like, but it's quite an important issue and creates quite a bit of burden for trustees. So if you think about what we've said, income that's falling within the £1,000 band is taxed at the basic rate, and equally dividends that come into the trust are either taxed at 7.5% or 38%. And yet when the trustees pay out income, distribute income, they have to account for 45% tax, and they haven't paid it. So that creates discretionary trustees a bit of a headache, really. It causes some challenges that we're going to try and address in here. And you won't be surprised to see that bonds do feature in here. So if you've dealt with this kind of stuff before, you'll know that bonds fit very well inside discretionary trusts. Hopefully this will cement the reasons why that is the case. So what we've got here, we've got a discretionary trust that was set up via a will a year ago. So it was settled at 325 with some cash, and it's now valued at 350. And that's the sort of portfolio that the trustees have been investing in directly. So they've generated 13.6, 13.7 of income across the trust. So let's have a quick look at how that's taxed inside the trust. Well, we deal with our savings first. We haven't got any non-savings income, obviously. So the first £1,000 of that is at basic rate, and the next 6.3 is at additional rate of 45. That exhausts the savings income. We then move on to the dividends, and we tax those at 38.1%. So all in all, we've had 13,600 odd of income in, and we're paying £5,400 worth of tax inside the trust. And I should stress as well, this is a non-settlor interested trust. So that means the settlor isn't a beneficiary, which would obviously make it ineffective for inheritance tax purposes anyway. But more importantly, their spouse isn't a beneficiary. And I mean spouse, not widow. You could have a separate class for widows, widowers, but spouse while they're alive, because that makes it settlor interested. And that makes the tax position a bit, what happens there is, imagine you've got a GIA indiscretionary trust and it's a settlor interested trust because their spouse is a beneficiary. That then means the trustees have to do their own self-assessment, which you can see there. The settlor then has to do his own self-assessment based upon the income the trust has received. If he pays less tax on it than the trustees do, he's then obliged to pay the tax back to the trust. So you actually end up with a settlor interested trust with GIA, you actually end up with two self-assessments on the same income. So it can get pretty admin heavy, really. So we've had the 13,600 of income on the way in. We paid 5,400 tax, and we've actually got 8,285 of net income. And the trustees are feeling generous, and they're saying, okay, let's distribute this income. The question is, can they distribute it as income to their beneficiaries? So let's boil it down to a bit simpler if we can. There's the trust, and same as our other example, the trust has received £1,000 of net income. And forget that £1,000 standard rate band, we're above that. So this is all at 38%. So if the trust is receiving that dividend and they're not going to distribute the income, then they would pay 38% tax on it, and they would have £619 inside the trust to accumulate. But they want to pay it out. They've only paid 38% tax on it, and yet they have to account for 45%. So what they'd realistically do without a tax pool, I'd say, is basically take that £1,000. They're going to pay the 38% on it, but they would also take another £69 of the 1,000 to make up the £450 of tax that they have to pay. And that balances their books, if you like. If they did pay out that 619 as income, then they would have to account for £506 of tax. And as you can see, they've actually only paid 381. So there is a real mismatch that the trustees can fall into with this position. So this means they can't pay out that 8,285 without another tax charge occurring.
Just had a question come in about a previous comment, John, did you say that all income within the £1,000 band is liable to basic rate tax? So if you've got a GIA with dividend earning investments, it'll also have to submit a tax return the moment they get £1 of dividend income.
Yes. Well, yeah. So as I say, the previous position before we got into gross income is that would have been taxed at source with a 10% tax credit, so no problem. But now they'll have income and it'll be gross. So again, interest and divvies could cause that position.
Okay, thank you.
So taxable for discretionary trust. There we've got our income of 8,285 after tax. We'd have to have a tax credit of 6,778 if we paid all of that out, but we've only paid tax of 5,400. So we've got a £1,400 mismatch in tax, and the trustees have kind of got to think about how they're going to deal with that ultimately. So what can they do? Well, what they could do, I suppose, is limit, although they've got that 8,285 of income after tax, they could limit the amount of income they pay. So they could literally distribute 6,600 of income. And when you obviously deal with the 45% tax credit, that's the £5,400 they've paid already. So they've matched it with the tax pool, and the tax pool would be exhausted. But if you're a beneficiary, there is potentially another £1,700 of income that hasn't been paid out ultimately. So, you know, you're a bit worse off. Admittedly, if you're a discretionary beneficiary, you haven't got rights to anything, but you might still be asking questions of why they've done that. So the trustees could potentially, and they can do this, if they've got income they can't pay out, in their minutes and meetings, they can say, right, okay, that's now going to be treated as capital, and they could distribute it as capital. But if you were present in the last meeting, distributing capital from a trust could then generate exit charges if you pay periodic charges that don't apply to income. So that can be a problem. And obviously the next consideration is they could convert all of that 8285 to capital if they wanted to. But as I say, that takes you away from the tax credit problem. If you're a beneficiary, you could be a non-tax paying beneficiary. You've received capital, you can't claim any tax back. So remember, if you're a beneficiary of a discretionary trust, if the trustees have paid 45%, you can reclaim tax to reflect your own tax position. But if they're giving you capital, you can't claim anything back. So you could be, causing a bit of a problem and asking questions around that. And as I've said, you're then into exit charges as well. The other way you could play it, and this could work depending upon the beneficiaries they've got and how they want to play it. They can create an IIP trust section, if you like, or even convert the whole trust to an IIP for income tax purposes. So they appoint a revocable IIP. So it's still subject to periodic charge. It's still in the relevant property regime, but you take on board the taxation of an IIP trust inside a discretionary trust. You kind of rewrite the architecture to say this is basic rate. So that could be a solution. But it really depends upon the beneficiaries they're dealing with. And on the next slide, Richie, it highlights basically, have they got a life tenant, somebody they want to pay a regular income stream to? Do they want to appoint an IIP at this time? If they don't, then they're back to these kind of problems that we're talking about in terms of their tax management. As I said, no surprises here. We get to non-income producing assets for trustees, and as I'm sure I've said, you've been to numerous seminars that kind of talk about why they're good. This hopefully gives you a bit more depth. But as you know, if you're dealing with certainly an offshore bond, you can purchase a capital redemption bond. And for trustees, what does that mean? Well, it means there aren't any surprises, because there won't be, aside from the ultimate maturity of the bond in 99 years, there won't be any chargeable events unless they want them to happen, unless they create them, because there are no lives assured on a capital redemption. It won't end when the last life assured dies. So quite a big tick in a box for a trustee.
Are there any downsides for using a redemption bond?
The only one that I would raise, certainly from an individual perspective, if you've got, as a power planner, if you've got an eye on care fees and means testing in the future, a capital redemption bond will be taken into account. Currently, if you're dealing with a life assurance bond, it should be excluded from the means test.
That's if the bond is still owned by an individual as opposed to a trust.
Absolutely, yeah. Absolutely. Yeah, and again, if you put any kind of bond into trust, if the authorities suspect that you are deliberately depriving them, then they will see through it and take it into account anyway. So any of this has got to go and be forming part of natural financial planning for the right reasons. And of course, if you have got your eye on the means test, you can't put any of that in writing anyway, because you're then planning around it. So it's kind of a conversation and a thought that you may have as a planner as to how you might proceed. But outside of that, a capital redemption bond costs the same as a life assurance bond. At all other aspects, it's taxed in exactly the same way. The charge of events is the same, but you're just taking away that issue of lives assured. And I'd say outside of trust, if you come across any onshore bonds where you are able to do something with them and you've got one life assured left on there, that's a reason to rewrite it for tax planning purposes, because even then you can then move it on and use it as a tax planning vehicle and pass it through without chargeable events. Inheritance tax may feature, but you're not going to pay income tax to get it through. And realistically, with capital redemption bonds, a lot of your clients who may be investing in the capital redemption bond today probably won't be the people that encash them ultimately, and we kind of see that from our existing book. You're then into different people's tax situations and perspectives. So we've got capital redemption bond, fits very well. Obviously, we've seen dividends and income are taxed at additional rates above the £1,000. Because the bond is a non-income producing asset, you're taking that stuff away if it was the only thing in there. So it takes away the need to self-assess. If that was the only thing you had in there, you're not creating any income. And equally, the need to use the trust register, because you haven't got any chargeable events particularly. And as you know, when you beneficiaries get to 18, you can assign segments out to them in their own name. They can encash and use their own tax allowances. So it can become more efficient there. And then, of course, you know, you've got open architecture. So the trustees are thinking about Trustee Act 2000. They're not using discretionary managers. They've got everything they kind of need in terms of risk under one roof, arguably, in there. I remember as well, if you're thinking about GIA, the capital gains tax allowance is halved at best. So it could be £5,850 at best. At worst, it could be £1,170 because it gets divided up by a maximum of 5 times the same as that standard rate band. So, as I say, it fits extremely well in there. And of course, the top of the list really that people talk about with offshore bonds certainly is gross roll-up. So we've just seen if you're unwrapped and as a trustee you were looking to accumulate income for future use with beneficiaries, you'd accumulate 8285. Whereas inside the bond, the 13685 that was received gross will stay as 13685. And I'm not a maths whiz, but I'd rather compound 136 than 82 to see what the number ends up at the end. Now, you know, I've mentioned a bond's non-income producing assets. The bit I want to concentrate on really is the assignment to beneficiaries. So I kind of mentioned that you can assign when you get to 18 in England and Wales. But what if you're a trustee dealing with a beneficiary who's under 18? Because you can't really make that assignment because they're not of age, they can't take legal ownership. But a bit like our school fees example earlier, it is possible to have the best of both worlds. A bare trust is very rigid. Once you've put that in place for your beneficiary, you can't change it and they can get the money when they're 18. So it may not suit everybody. Discretionary trust is massively flexible and the trustees can decide if, when and how they pay to a beneficiary. But you could also use a bare trust in conjunction. And this is something that Utmost actually offer off the peg is a deed to assign to a bare trust. So you could actually have our Educate Grandad putting money into discretionary trust in an offshore bond because he wants the flexibility. He's worried about future grandchildren being born because he couldn't add them to a bare trust. They can be included under the discretionary trust. And what the deed actually allows you to do is effectively make an assignment to the child because you're actually assigning it to the bare trustees. And if you're a bare trustee, all you're doing actually is holding the asset on your beneficiary's behalf. You're like a nominee owner in that sense. So we could have, if we skip on to the next slide.
This is news to me. So I guess as long as the bare trust is created for the benefit of one of the classes of beneficiaries in the original trustee, that's okay. And it's the trustees of the discretionary trust in this case that decide who that goes to, not the settlor.
Yes.
Okay.
Yeah. I'd say it's not something that kind of sits alongside and stays there and trundles along at the same time. What this is really a function of getting it assigned to the beneficiary. So it's like there for a flash moment. It's assigned to the bare trust, segments are surrendered, and you see through the bare trust and tax the beneficiary.
Okay.
Like same as we did on the full fat bare trust.
Yeah. So
it's a way of getting the money out and using their allowances.
Okay. Does this only work for non-parental assignments?
Yes.
Okay.
Absolutely. So if mum and dad put the money into the discretionary trust, then you're going to go back and tax them anyway. So that's where you have to be careful. So non-parental again.
Okay.
So just a simple example, original bond of £100,000 with 10 segments, and it's grown to £180,000. So the trustees could assign 2 segments to this bare trust that's been created just to receive the assignment. And we'd end up with a £16,000 chargeable gain for segment surrender of those 2 policies. And of course, we're seeing through the trust and we're taxing the child who's got £17,850 of allowance, so we don't pay any tax. So it really gives you the best of both worlds in that way. Different options. So just as a visual really on the income tax side, if you think about IIP and IPD trusts, basic rate tax paying animals, as I said. And on the left there, you can see all the income coming in its different forms. The thing to remember is it's gone through the tax tunnel that I described and it's ended up in the hands of the beneficiary and it's maintained its nature. It's still a dividend. It's still savings income. So that means they can use their own allowances. And on our lady, if she'd had her dividend allowance, she could have reclaimed the tax and had nothing to pay. So it maintains its nature, goes through the tunnel. If you're thinking about a discretionary trust, the same income comes in on the left, but it comes out as something entirely different. Because of this process of tax pools and the trustees having to account for 45%, it doesn't come out as a dividend anymore or savings income. It actually comes out as trust income. And what is that? Well, that's non-savings income. So the only thing a beneficiary can actually do against that really is use their personal allowance, if they've got that, or reclaim tax, because they might be receiving income that suffered 45% and they can reclaim 25 because they're a basic rate taxpayer. But it doesn't maintain its nature. And that's one of the complications really around dealing with income through a discretionary trust with GIA and shares and such like. It creates a massive burden. One final thought to leave you with really. We've talked a lot about the way the trustees pay tax, but things to remember. If you're dealing with a trust, forget bare trusts. If you're dealing with an IIP trust or a discretionary trust, then you have a bond in there and there is a chargeable event and the settlor is still alive, forget all that trustee stuff, because the settlor will receive the chargeable event and they will have the tax bill. Okay, so the options you've got is back to the settlor. If the settlor's died and the trustees are in a new tax year, and they're dealing with a capital redemption bond or they're dealing with a life assurance bond, and then they create a chargeable event, they will suffer the chargeable event on the trustees. If they sign out, then they pay tax, or the beneficiaries pay the tax. But here's another variation. What we've got here, discretionary trust created via the will. So the first one here, the husband has died. He's passed £325,000 into a discretionary will trust for the benefit of his wife. Now, as I said, he's dead. So everything we've talked about in terms of the trust on the discretionary trustees is as I've described, 45%, 38.1 and so on. That's exactly how you'd think about it. So if you're thinking about investments in there, you're looking at the trustees. However, a crucial question to find out is, how was the trust created? Option 2, slightly different. The husband has died and he's passed his estate to his wife. So spousal exemption. His wife, within 2 years, then decides to use a deed of variation and have a discretionary trust set up for £325,000. That's now changed the game a bit, because what we could end up with is a basic rate tax consequence here if the spouse was a basic rate taxpayer. Because what happens is when you put in place a deed of variation and you're the one that varies it, you are deemed to be the settlor of that trust. Even though it's effective for inheritance tax purposes, you're the settlor. So we're back to that position we described earlier, where the trustees, if you're holding GIA, would have to do their self-assessment. The surviving spouse would do her own self-assessment and will be obliged to pay tax back if she's a basic rate taxpayer or less. Again, if there was a bond in there, the chargeable event will go directly back on her as the settlor, and you won't have the double chargeable event situation. So the whole aspect of who is taxable is a session probably in itself ultimately, but a key question to ask in terms of how the trust is created. So a little quote here just to leave you with, taken from case law, Hurlingham Estates versus Wilden Partners. This wasn't actually a trust case. It was a conveyancing case, and it was to do with a solicitor who strayed away from commercial to residential conveyancing. I think it was that way round. And the client ended up with a pretty big tax bill that didn't have to have occurred had the solicitor known his stuff. So the quote was, the solicitor had entered the tax minefield armed only with a precedent book, knowing neither what to look for nor the significance of what he found. So hugely damning sort of sum up by the judge. And you can really transpose that to trustees, certainly lay trustees as well, and how exposed they are to challenge ultimately, and what that might mean for them, because that kind of thing could equally apply. So remembering they can actually, take advice from people that know what they're doing. So remember this tax pool, remember the burden, don't underestimate the burden that can be taken away from the trustees with the use of the right, strategies, whether that's appointing, making the revocable appointment to IIP, or that's using bonds or whatever it means. But hopefully that's given you a bit of a dust off of existing knowledge, maybe giving you some new aspects to old knowledge as well. And don't forget, Utmost are always here to help you with this stuff. So thank you very much for your attention.
Thanks, John. I've learned something new there, in particular, which is always good for tuning into one of these things. So thank you for that. It's also brought back some memories I thought I got rid of as well, particularly around tax, which is never a good thing. So thanks for that.
Horrible.
As always, you can get hold of a copy of the slides and your CPD certificate by clicking on that link I've just put in the chat room there. A lot of people I know are getting the slides and going back over these again and watching what John says along with the slides and making notes. So it's a really good CPD resource from that point of view. You can carry on the conversation in the Big Tent on the main Powwow site as well. If you've got any particular questions, then stick them in there or email us and I'll see if John's got time to answer those. So thanks once again to John and to Utmost for making these happen. We really appreciate those. The next one in the series is next Tuesday when we're looking at pension death benefits. Looking forward to that one. Don't forget there's still tickets left for the report writing Howell Bonanza in Manchester on Thursday, 28th of June. You can get more information about that on our website. Thank you all for tuning in and for all the questions we've had as well. The replay video is coming up very soon and we'll see you again same time next week. Thanks very much and bye.
Thanks, mate. Cheers.